It's the year 1900. You just received your pay after a long day of work. You head over to your local bank to deposit your cash. The transfer is complete and your cash is now secured behind the vault. However, bank owners had a strange feeling. They realized all the money held in their vault wasn't making them any money and was just stored for no particular reason. This situation has led them to have a genius idea for the future of banking. Now fast forward to our present day. You repeat the same process of depositing your funds, the transfer is processing, and now complete. Your money now appears in your bank account, but in reality, it actually doesn't exist. Banks have the power to literally take your money and loan it to other people, which they then collect interest payments on those loans. This is just one of the multiple ways of how they generate income. Today, banks only need a fraction of the money you deposit in your bank account as reserves, which is usually around 10%. And can lend the rest of the 90% to other people or businesses as loans and receive interest payments. Let's say you deposit $1,000. The moment you walk out the door, the bank could turn around and loan out $900 of it to someone else. Once that happens, the money supply has increased. Instead of the $1,000 you just deposited, the money supply is now $1,900. Don't forget, your $100 is still on reserve, which is 10% of your deposit. Banks can also loan money to other banks. When they do this, they charge a special interest rate called the federal funds rate, and banks are collecting huge interest payments from them. As you can see, it's a massive bubble that grows the money supply as more banks continue to make loans. Banks make money by charging fees. You see those sneaky little charges pop up on your statement every month? There are fees for maintaining your account, for overdrawing your account, and sometimes fees for using a cash machine. Banks are also heavily involved in trading. They trade stocks, bonds, currencies, and other financial instruments. They do this for their own accounts as well as on behalf of their clients. Banks make a lot of money, which increases the global money supply. But how do they manage risk? Let's be honest, lending money out that belongs to someone else isn't exactly risk-free. What if that person or business can't pay back the loan? Banks are always lending, borrowing, and investing, and need to ensure they're not making bad business decisions. That's where risk management comes in. Imagine you're a bank and have a customer who wants to borrow money. You could just hand over the cash and hope for the best. Instead, credit checks are made, reviewing your past payment history and how much you can earn. Banks may also require collateral. Collateral essentially offers something of value that the bank can take possession of if you're unable to pay back the loan. They hold the legal right to seize anything if needed. The most common forms of collateral involve real estate. You've probably heard the saying, don't put all your eggs in one basket. Banks have taken that advice to heart. This way, if one of their investments goes bust, they still have many others to fall back on. They also have securitization. This is when banks take a bunch of loans, like mortgages, bundle them all together and sell them to investors. Securitization helps banks reduce risk, free up capital to make more loans, and of course, raise interest. If their risk assessment decides that certain loans would be better sold off, that gives them more security. You might be thinking of secret Swiss bank accounts or shady dealings in the world of offshore banking. While offshore banking can be used for tax evasion and other purposes, it's not about stashing cash away. Banks also use offshore centers for legitimate reasons, like international trade, investments, and risk management. Banks constantly look for new ways to make money and stay ahead of the competition. This may involve developing technologies like mobile banking and cryptocurrencies or new financial products and services. Of course, as we've seen throughout history, when banks take on too much risk or loan out to people who can't repay it, that can lead to financial crises and economic collapse. That's why rules have been applied to keep banks in check. Unfortunately, they don't always work. The savings and loan crisis of the 1980s is a classic example. They are not the same as consumer banks, but they work in similar manners. Their bread and butter is with residential mortgages. One of the reasons they started was to provide more Americans access to mortgages, but they started making risky investments. When those investments went bad, the entire industry collapsed. The fallout? $160 billion bailout from the US government. Then, in the early 2000s, the notorious Enron scandal erupted. Enron was a massive energy company that went belly up after it was revealed they had been cooking the books and hiding massive losses. Some of the biggest banks involved, like Citigroup and JP Morgan, helped Enron hide its financial troubles. The world was rocked by the 2008 global financial crisis, and banks were right in the thick of it. When banks focused on subprime mortgages, they got carried away and lent to people who couldn't afford them. Then they packaged those risky loans into complicated financial products. When the housing market collapsed, that house of cards came tumbling down. The government had to step in with a massive $700 billion bailout to save the financial system. A few years later, the LIBOR scandal hit. LIBOR is a benchmark interest rate that affects everything from credit card rates to mortgages. Well, it turned out that some banks were manipulating LIBOR to make themselves look healthier than they were and rake in extra profits. This scandal led to billions of dollars in fines, and some bankers even went to jail. In 2016, it was revealed that Wells Fargo had created millions of fake accounts in customers' names without their knowledge or consent. The result? A massive public outcry, a CEO resignation, and a $3 billion settlement. So what can we learn from all these banking scandals? For one, not all banks behave as honorably as we would like them to. They're in the business of making money. When you control other people's money and money supply, it can and often does lead to some bending or breaking of the rules. It's also important to remember that not all banks are bad. Plenty of honest bankers are working hard to keep your money safe and help the economy grow. These scandals have also led to some positive changes. Each time a major scandal erupts in the banking world, new regulations and security are put in place to prevent similar problems. While it's interesting to revisit these notorious moments in banking history, it's important to recognize that they have come up with a more secure and stable financial system. Without these scandals, we might not have had the changes that make our banking system safer today. The Enron scandal led to the Sarbanes-Oxley Act, which tightened corporate governance rules and increased penalties for fraud. The 2008 global financial crisis resulted in the Dodd-Frank, which strengthened regulations on banks and created agencies to protect us from shady behavior. Yet even with new rules, there's always the risk of another banking scandal hiding just around the corner. That's why we must stay informed about the banking world and hold banks accountable for their actions. Banks have a lot of power. They create money, lend it out, and keep the economy strong. However, with great power comes great responsibility, and banks have proven they're not always responsible. That's where regulators come in. These agencies keep banks in check and assure they don't put us all at risk. They set the rules and make sure banks are playing by them. But who are these mysterious figures? We have central banks like the Federal Reserve. They set interest rates, control the money supply, and oversee the strength of the financial system. They also have the power to step in and rescue banks in trouble. Office of the Comptroller of the Currency, or short OCC, is pretty much the strict parent of the banking world, ensuring banks follow the rules and keep your money safe. They conduct regular exams, set capital requirements, and even step in to shut down misbehaving banks. We also have FINRA. Their task is to set rules and standards for financial professionals, enforce those rules, and even provide training and education. This is another layer of checks within the financial industry. Another aspect of governance is the bank's risk management framework. Remember how we talked about banks managing risk? Good governance means having a solid risk management system with clear policies and procedures. This helps banks stay on top of risks and avoid any nasty surprises. This whole system is built on trust. When that trust is broken, everything goes out of control, and we end up with financial crises and bailouts. But it's not just trust that gets broken. Millions of people can also be left broken and lose all their savings, even everything they'd set aside to retire with. All gone.